So the information discussed in the presentation is current as of the date noted and is for informational purposes only. It does not intend to address the financial objective situation, the specific needs of any individual investor. Any information is for illustrative purposes only and is is not intended to serve as investment tax or legal advice, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Results will vary, and no suggestion is made about how any specific solution or strategy will perform in reality. Now that we got that fun stuff out of the way, next slide. Who we are and why we're here. So we represent John Ulvin and Associates. Give you a little bit of our background. We've been here in the area for 45 years, and we serve clients in 44 states nationwide. Our offices, we have our headquarters in Corning and Big Flats, New York, and we have a branch office in Rhinebeck. We service clients all over the place. How do we service those clients? By a list of services here: financial planning, investment tax preparation and planning, estate planning, retirement planning, and so much more. There's an unofficial catchphrase that we use to help describe what we do. I don't know if anybody in the room knows the catchphrase, but we help with everything.
Money touches.
Everything money touches. That's right. We try to help our clients with everything money touches. That was cute, guys. That was really nice. Well coordinated. What allows us to be able to be here, though, is that we don't sell any products. That's why we're able to work with organizations like JGUA College and other local nonprofits to provide education. Because we don't sell anything, we are positioned to be able to have as few conflicts of interest as possible, which allows us to speak to you guys and educate. Make sure you follow us online. We produce a lot of content, and there's a lot of ways to access that content. Join us on YouTube, Instagram, Twitter, LinkedIn, Facebook. You can also go on our website, www.jgua.com. We got lots of goodies out there. We have a podcast out there. We've got a little bit of everything. Go ahead. We're going to introduce our lovely presenters. This gentleman right here, Darren Wilcox. Darren, he has been with our firm for nearly 17 years. He is one of our senior vice presidents, general counsel, corporate secretary. He is a CFP, which is a certified financial planner. He has his JD as well from Texas Tech University School of Law. And he is a sneaky good basketball player, I'm told. He is going to be concluding the second half of the presentation, discussing, I'm going to get to that later, but he's gonna close the presentation. Opening the presentation is this good-looking guy, Mark Abdalla. He has quite the credentials as well. He is a research analyst. He's been with us for 5.5 years-ish. That was a guess. Thank you. He's a research analyst. He's a CFA, Certified Financial Analyst. He has his master's in economics from Boston University. He has his MBA from Cornell Johnson Graduate School of Management. And he has his bachelor's in economics from Carnegie Mellon. Very impressive, and he's going to open the presentation talking about the economy and different economic market factors. Next slide. Let's see. So this is a one of 4 course offerings. So we're starting out here with investments. Next one's going to be retirement. It's going to be retirement, and then this should actually be in tax planning, I believe, and then legacy. So legacy is going to be more of the estate planning type items, charitable gifting. The way today is broken down is quite simple. Mark is going to discuss the economy and stock market factors, as you see here. And then there's going to be a Q&A section. At this point is where we'll address our audiences and our friends online. You can chime in using the chat feature or just unmute yourself. The room should pick up your voice. If not, we'll go ahead and echo what you're saying so everybody, all the participants can hear. And we'll have a brief break here, and then we'll transition into the your retirement products that get affected by the market conditions. Let's see. We did a disclosure. We talked about the Q&A section. Did I leave anything off the table? For those that have already pre-registered, we have a nice list of those that have registered. You will automatically be registered for the other remaining courses. You will get notification via email. If you can't attend or you want to opt out, you absolutely can. We're going to go ahead and do that for you and provide continual resources for the upcoming presentations. Without further ado, I'm going to hand the mic over to Mr. Mark Abdalla, who will talk about the stock market.
Well, thanks so much for the kind comments, William. I wasn't expecting to be called good looking. I owe you a drink for that one. And in all seriousness, I'd like to thank the marketing department at John Gilman Associates. Really wonderful job putting these series of events together. And Darren and I have the easy job today, just giving the presentation. I'll be covering the stock market and the economy. These are topics I happen to cover every day. So happy to take your questions on them when the time comes at the end of my presentation, whether it's in person or whether it's online. So go ahead, if you have a question on your mind, go ahead and put it in the chat. And we're looking forward to the Q&A section of the webinar as well. We'll start off with what is a stock. When you buy a stock, you are buying ownership in the company. Darren will talk about bonds later on. That's a debt instrument. A stock is a security where you have ownership of the underlying company. So as an owner of a stock, you have a right to all future earnings of that company. When the company makes a profit, you're the owner. You have a right to that profit. You have a right to all future dividend payments from that company. Right? When the company pays a dividend, you have a right to collect that. In fact, a lot of investors buy stocks for the dividend. You also have a right to vote on who runs the company. Right? You have a right to vote at the annual meeting where they put the board together and they decide who's the CEO of the company. Right? So you have a proxy voting right as an owner. And the fourth right as a stock owner is you have a right to residual assets in the case the company goes bankrupt. So heaven forbid, you buy a stock and it goes bankrupt. You're not first in line to the assets that are left over. You're actually one of the last ones in line as a stockholder. The pension has to be paid, the employees have to be paid, the debt holders have to be paid. After all those people are paid with the underlying assets, if there are any left over, as a stockholder, you have a right to those assets. Why would a company sell a stock? Well, a company sells a stock, essentially they're selling ownership of that company to raise capital, which they in turn can use to fund business operations. Usually they're funding some kind of expansion project. So you see a lot more capital fundraising happening when the economy is doing very well and companies are looking to grow. Moving on to the next slide. How are stocks traded? So when stocks are initially traded, the company is selling stock in the primary market through this process of an initial public offering. It's known as an IPO. If you have a private company and you want to make it public, you go through this initial public offering process. The minimum generally expected from bankers that will deal this IPO is $50 million worth of capital being raised, right? So if your company is worth $100 million and you want to sell half of it to other owners, you could go through this initial public offering process, sell it on the primary market. Once it's sold on the primary market, other investors will want to buy it on the secondary market. And the secondary market, you have stocks traded either over the counter or on stock exchanges. So here's a list of many different stock exchanges. To be listed on the New York Stock Exchange, there are criteria by the exchange for that listing. So they're not going to just take any company and list it on their exchange. When you get to if your stock is listed on that exchange, it can be traded with many, many traders. So typically, companies want their stock listed on an exchange. For the New York Stock Exchange, you have to have good earnings, good cash flow, good revenue. So there is criteria to make that exchange. Other exchanges have less stringent criteria. The Toronto Stock Exchange, the criteria for being listed on that exchange is a little less stringent than the New York Stock Exchange, for example. And then typically each country has one stock market exchange that they're known for. So if you're trading stocks in Japan, you probably go to a broker on that exchange and buy stock through that broker on the exchange. And that's just how stocks are traded through these exchanges. Next, discussing the economy and the market. Economic and market drivers, there tends to be a lot of overlap. The economy is not the market, but there is a lot of correlation, right? So when you think of what's driving stock prices, well, a lot of it is supply and demand of that particular stock. How many buyers are out there? How many people are bidding for that stock? How many sellers are out there? Is the company issuing a lot of stock or a little bit of stock? And that will set the price of the stock. You can take that same demand supply principle and apply it towards the economy. How do you price goods? We'll talk about inflation in a little bit. But essentially, if you have a lot of demand for that good, prices go up. So that's a driver of both the economy and the stock market. What's interesting about the economy is that it's cyclical, right? Every day is different. Every year is different, right? So sometimes you have economic booms, and sometimes you have economic busts, right? And we've seen throughout history many booms and busts. We have a good slide on this, going back all the way to World War I on the recessions. If that happened, that would be a bust. You see on this slide as well, this gray area covers the recessionary bands, right? So, in the early 1980s, you had interest rates going up and up and up, and that caused a recession. In 1990, you had the Gulf War, a little bit of oil price shock there, that caused a recession. In 2000, you had the technology bubble, right? It bursted. You had overpriced technology companies, and you had a burst. The bubble bursted, and with that, contraction in GDP and recession in 2001. In 2008, you had the financial crisis. We talk about that all day. You have a different speaking session just for the financial crisis. But essentially, home prices came down, and banks were over-levered. There were too many mortgages out there. The value of the mortgage was greater than the value of the home. And big financial crisis caused what's known as the Great Recession. That was a pretty big recession in 2008. You see that recessionary band here. So periods between these recessionary bands, you see economic growth. Every once in a while, you see a drastic correction when it comes to the economy and economic contraction. Talk a little bit about what causes that contraction and that growth in a little bit, and we discuss inflation. But just calculating GDP, gross domestic product, right, that is the measurement of the economy. How much is the economy producing? 70% of gross domestic product comes from you and I as consumers. How much are we spending on consumption? How much are we spending at the grocery store? On a new car, perhaps. So that the health of the consumer cannot be understated when it comes to thinking about the health of the overall economy. We have 17% is government spending. Right? If the government spends a lot, that will boost the economy. It could also lead to higher government debt. We'll talk about that a little bit as well. It can actually lead to higher inflation as well. And then 18% is from business investments. So our local businesses investing more, they're trying to expand. That's a driver of the economy. And then the rest is exports minus imports. The United States happens to import a lot more than it exports. This actually works against the GDP number. But really the big driver, key takeaway from this slide, is that it's the American consumer driving the US economy. And looking at the real GDP growth rates and real GDP. So for real GDP, you're factoring in inflation, right? We take nominal GDP growth. And you can see from this slide how the growth rate's been pretty steady over time, right? You have these recessionary bands, but over time, the GDP tends to grow. So with that, we're on to the next slide on inflation here. So this is the CPI, what's known as the Consumer Price Index. And the Consumer Price Index essentially measures inflation.
Need to take a moment to get the slides together. That's right.
All right. Take a slide right here.
There you go.
Thanks.
Yep.
A lot of slides.
Yeah, it is a lot of slides.
Hopefully everyone online is keeping up, but I can't tell if they want me to slow down or
I think you're all right.
quicken the pace. I'm running out of time, but yeah, just give me a thumbs up. Let me know. Please tell everyone on chat. I'm looking forward to their questions in the Q&A break. So hopefully we get some interesting questions. This slide's on the consumer price index, which again measures the inflation rate, right? So are consumer prices going up or are they going down? Are they steady? It's actually measured. The government measures these price changes through this consumer price index. So with that, looking at this pie chart, 44% of the consumer price index, or you think of it as of inflation, that inflation rate, is measured by the cost of housing. So if you're wondering if inflation is going up, you could ask yourself, is your rental agreement, the price on your lease, is that going up? Is your mortgage payment going up? Right? The cost of housing, is that going up? If it's going up a lot, that means inflation is running hot. Inflation is high when the cost of housing goes up a lot. Another 14% is food and beverages, and 16% is transportation. Those are two big factors together. So what drives the cost of transportation? Well, it could be your car payment. It could also be how much it costs to fill up your gas tank, right? So paying a lot of gas, chances are those transportation costs are higher. So that can really drive inflation. In fact, the Inflation Reduction Act legislation that was passed, it has that term because the idea is they'll reduce that cost of gas at the pump over time with that reduced inflation, right? So the price of gas is really a driver of overall inflation in the economy. It's direct towards transportation in the CPI index, but it also leads to higher food prices, higher beverage prices, because food and beverage has to be transported as well. So if you're paying higher in transportation costs, chances are you're paying higher in products that are transported. So really a big driver of inflation is the price of oil. And that was high last year. So we saw high price of oil and high inflation. It wasn't a coincidence. You can see over time, going back to 2000 here from this chart, what prices have really taken off and what prices haven't. So medical care prices have gone up a lot, right? That's in red here. Apparently apparel, the prices have actually gone down. You're actually paying less now for apparel than I guess that's clothing, right? Than you were in 2000. Interesting, we're here at JGUA College, and we see college tuition astronomically off the chart here. Right? Doesn't even fit in the slide, right? College tuition has gone up so much since the year 2000. And I don't know what the college tuition rates here are at JGUA College, but I'm willing to bet they've gone up quite a bit as they have nationwide since 2000. And I'm sure since you started working at the college, tuition's a lot higher. Is that correct? Yeah. So it's not. It's in the numbers as well. That's a nationwide issue. For the CPI history, this I think is one of the most interesting slides to me. Looking at history, going back to 1914, that's when World War I happened. Inflation picked up. So wars tend to cause higher prices, right? And inflation. You see that in the data. World War I, inflation was really strong. World War II also, you see that circled in red. 1940s, really strong. 1970s, you had higher inflation. You had the spiral effect of wages going higher, and then with that, unions demanding more, and companies therefore raising prices. You had the spiral effect that caused prices to go higher and higher and higher. And the Federal Reserve at the time decided to be really aggressive against fighting inflation. And they raised interest rates. The chairman was Paul Volcker at the time. He raised interest rates to bring down inflation, which was controversial at the time. Because when you raise interest rates, essentially you're slowing down the economy because you're increasing that cost of financing. And we're seeing similar times. You can say we're in a similar period now of higher inflation, higher interest rates. I'll take questions on that in Q&A. What's interesting also, when we see areas circled in green, and this is periods of deflation. So what's deflation? That's actually when prices go down. That happens during a recession. So in a recession, people are spending less, right? They're worried about their employment, usually, and other adverse economic effects. And therefore, they're willing to spend less, And because they're spending less, prices go down. Right? So the prices are determined by demand supply. Demand goes down, prices go down. And that's what we saw in 2008. And the recession there, prices went down. You had a period of deflation. So now discussing the market, bullish versus bear market. So this is financial lingo. Right? If you're in the finance world, I've been in the finance industry 20 years now. So this is a common language in the finance world. The bull market's when the market goes up. Bear market's when the market goes down, right? Essentially. There's some definitions here for a bear market. It could be defined as a bear market. Stock prices have to fall 20% or more. So last year, the S&P 500 was down 18%. You can say it's pretty close to a bear market. There was a period there where you hit that 20%. And in the bull market, stock market's been up this year. So we had a recovery. You could say this market so far, the S&P 500, which captures 500 large stocks, and the price movement, that's done very well year to date this year, right? So I take more questions on that on the Q&A, what's going on currently in the stock market. But that's the overall definition of bear versus bull markets. And there's correlation between the economy and the stock market. They're not the same, but there's underlying economic drivers that impact the stock market. In fact, the stock market is a leading economic indicator. One of the 10 leading economic indicators is defined by the Conference Board. Generally, when the stock market goes down, investors are expecting a recession, generally, in the future, right? So they're nervous about company earnings. They sell the company's stock. So it's based on that economic expectation, and therefore a leading economic indicator. There are some periods, however, where investors expect the economy to do poorly, or there's some reassessment of stock prices, and the stock prices will go down, and there isn't a recession. Right? So we haven't had a recession yet this year. The economy continued to grow, but there were a lot of expectations on that on a recession, and there's still a lot of economists that, based on the leading economic indicators, are predicting a recession. So it's mixed data there, but generally speaking, the stock market is a leading economic indicator of the overall economy, and it does share some of the same underlying drivers as the economy. So this next slide is recession versus depression, and this one I want to quote my grandfather. He passed away in 2017, but he was born in the booming 20s in 1926, and he lived through the depression in the early 30s. He was a kid, but impacted his childhood. And he had a saying about a recession versus depression. He would say, if there's a recession, that means you're out of a job. If there's a depression, that means I'm out of a job. So that was his saying. Maybe I fumbled that a little bit. It's reversed. But basically, if there's a depression, unemployment's really high. And that's what we had in the 1930s. Now we have a more reactive monetary system. So there's steps that the government takes to prevent these deep depressions that are prolonged. But there's a lot of concern on in 2008 with the financial crisis. Some economists thought that would lead to a depression. The government stepped in to avoid it. We still had a recession. We had a recovery as well. I'll discuss that a little bit, what the government did there. So this slide actually, like this as well, you have recessionary bands here going back to 1920, and you can see the depression in the 1930s. And you'll see the wars here and how that impacts the economy. But what's key takeaway for me is that inflation has been very low for the past 40 years. You see that in this slide, right? So this is the consumer prices year-over-year change. Essentially, that black line is the inflation rate, right? So during the recessionary bands that you see here, you have negative inflation or deflation. Right? You saw that in the global financial crisis, 2007, 2009. But you see very low inflation since essentially the early 1980s, right? And that changed more recently. We'll discuss that more in Q&A. The Federal Reserve currently has a target inflation rate of 2%. It's higher than that currently. But again, I get happy to take inflation questions of what's going on there currently during the Q&A section. The stock market, I mentioned the S&P 500 before, maybe that's above, some people's heads, and it's actually just an index, a stock market index, right? So it captures 500 stocks, and it's value weighted, or what they call market capitalization weighted. So the higher the valuation of the stock, the higher the weighting in the stock market index. Right? So you see these big technology stocks, valuation is really high, therefore they have a very high weight in the S&P 500 index. So it's the largest 500 publicly traded companies in the United States. There are some constraints to being part of the index. You have to be in the United States, for one. And since 2017, July 2017, the S&P 500 doesn't allow companies with dual class structures. So before 2017, you saw this with technology companies. They would issue two classes of stocks, one with a lot of voting power, try to retain that stock, that class for themselves, and then others to investors with less voting power. So you saw some technology stocks do this. So to discourage this, the S&P 500 basically said, we're not going to list you if you have multiple shares class structures, right? So investors really just want one class structure. Everyone's equal owner, not these dual classes that they have. Another limitation of the S&P 500 is that these overvalued companies, because it's value weighted, make up a large percentage of the index, right? So, sometimes the price of the stock goes a little bit too high during a bubble, you could say, and the index will weight towards the value of the stock. So, if you're, for the 5 largest companies in the United States, they make up a good percentage of the stock market index, and that's considered a limitation. That's due to their big size. So moving on to back to the economy and the unemployment rate, right? So, I mentioned that consumers make up 70% of GDP. And what really makes a consumer a healthy consumer and one that spends a decent amount of money is the unemployment rate, right? The lower the unemployment rate, the stronger the American consumer. And you have this official rate, which again I can talk about more in the Q&A section. I'm hoping for some questions here. A lot of teasers out for the Q&A section. That official rate is very low right now. But however, that doesn't include discouraged workers, right? The official rate is defined as the unemployed population divided by the civilian labor force. The civilian labor force doesn't include discouraged workers or part-time workers that are discouraged from looking for full-time jobs. If you look at that rate, it's higher, right? So the one you hear about in the news is the one that doesn't include people that have gotten discouraged from looking for a job. And another very topical conversation is the national debt at $31 trillion, right? Essentially, U.S. government has to raise their debt ceiling to pay off, to pay their bills, just what they have to pay government employees and all the contractors out there. But also, they need to increase that debt limit to pay their debt, right? They have these coupon payments that are due. They have debts that are maturing, these treasury bonds have maturity dates. And they need to issue more debt to pay debt. So you have this debt going up and up and up. And it's gone up as a percentage of GDP as well. The United States GDP is currently at 23 trillion. So, looking at this chart, you see in 1970, the U.S. debt was only 40% GDP, and now it's well above 100%. So that's concerning to a lot of economists. What is inflation? Well, we discussed the consumer price index. That's the measurement of inflation. That's how economists track inflation. But essentially, inflation is prices going up, right? We talked about the cost of housing, the cost of filling your gas tank. The prices of everything is going up, and that could really hurt a good part of the population, especially for people living off a fixed income. Right? If you have an annuity and you have that annuity payment coming in every month, that same payment, but the price of everything else goes up, that can be a problem. Right? So inflation generally speaking, is a problem for much of the population. And we find that as purchasing power. So you have income coming in, but what's the purchasing power associated with that income? If you have really high inflation, that purchasing power diminishes. Right? And that's a big concern for the country and across the world with higher inflation rates. So how are we solving inflation or trying to mitigate that? Well, we have the Federal Reserve Bank that came into place after the SEC came into place, the Securities Exchange Commission. And basically, the Federal Reserve has a dual mandate. One is to stimulate the economy, make sure that the economy does well. And the other mandate is to combat high inflation. They don't want to see everyone, especially people living off fixed income, have to face higher prices, right? So there is this dual mandate. And one of the tools the Federal Reserve has is changing their Federal Reserve rate, the rate of money, the interest rate that they loan money to member banks. So majority of US banks are member banks from the Federal Reserve. What does that mean? It means they have the ability to borrow money from the Federal Reserve. And the Federal Reserve can raise this rate to make it more costly to borrow money from them. And when they do that, when they raise the rate that member banks borrow from them, that gets passed on to consumers and businesses. So think of your car loan, your mortgage, that rate will go up as well because banks lend money based on how much they have deposited. If they have more money they have deposited, the more they can lend. But if they're borrowing at a higher rate from the Federal Reserve, then they are lending at a higher rate to consumers, right? So banks have to make income as well, right? So they make income by lending more than they're borrowing, and the cost of borrowing goes up, then the cost of lending goes up. And when the cost of lending goes up, when our loans become more expensive, maybe we don't take out that loan, right? If car loans interest rate becomes too high, maybe we don't buy a car this year, right? If mortgage rates come up, maybe we don't buy that home, right? So that's one way of that the Federal Reserve has on combating inflation. And this slide on money being printed. So the other big tool that the Federal Reserve has is what they consider printing money. And essentially what the Federal Reserve does is they buy bonds or mortgage-backed securities. They buy them from financial institutions, essentially inserting money into the system. So when you and I want to buy a bond, we need money in our bank account. When the Federal Reserve wants to buy a bond, they don't need money in their bank account. They have a limitless supply. Right? They're the Federal Reserve. They send you an IOU. They say, here's the money being deposited in your account. And when they buy these treasury bonds or mortgage-backed securities, and a financial institution selling them, there's more money in the system because that financial institution is selling this bond and therefore having cash with the sale, right? So when the government sells bonds, they have more cash. This is one way that the Federal Reserve increases the money supply. Therefore, quote, they print money through this technique. And the balance sheet has gone up quite a bit since that 2008 recession. How big the financial crisis was, how big a concern it was for the economy. The Federal Reserve really stepped in and very aggressively printed money through this quantitative easing program where they bought treasury bonds and mortgage-backed securities. I'm going to talk all day about the financial crisis. I'll leave it there for the Federal Reserve. They have a couple of tools. One is they can buy these assets directly and inject money into the system. The other is they can lend to other member banks and control that lending rate through the rate that they lend to member banks.
Okay, so for my section, we're going to start off talking about traditional investments versus alternative investments. Okay, so the two categories, traditional investments are ones that you're going to find most often in a stock market. Mark already talked about different types of stock markets. These are stocks and bonds, for example. You can find those, you can usually buy those in an investment account like at a Fidelity or a Vanguard. That's where you're going to see those. Alternative investments are a little different. They tend to be more tangible. It's harder to put a value on them. So stocks and bonds, very easy to put a value on them. You know what ExxonMobil is trading at. You can look at the stock market and see what it would cost you to buy shares of that. If you want to go buy a quart of lumber, it's going to be a little more difficult to figure out what that might cost. So that's the problem with alternative investments. They can also, but they have their pros and cons. There's good and bad things about both of those, depending on what you're trying to do with your investments. And they all play a role in the overall strategy that you should be having as you go. So let's start off talking about traditional investments first. So first up in traditional investments, we have stocks, bonds, and we'll talk a little bit about all of these. So Mark's already covered stocks. Generally speaking of what is a stock, right? That's when you buy into a company, so you're now an owner, albeit probably a very small owner, but an owner nonetheless. So let's look at an example of that. So let's decide you really like the business structure of Amazon. That's something, you like the way they run, you like the way that they do business. So you decide you want to go buy 10 shares of Amazon stock. So congratulations, you are now a part owner of Amazon. The company does well, as Mark talked about, they may pay out a dividend or some of their earnings will come back out in a net form to you. Maybe, maybe not. Now, those 10 shares right now will cost you about $1,000. That might work, depending on where you are in your life. $1,000 might be a lot of money. It might not be. If your overall investment portfolio is about $2,000, though, you just committed half of your investments to one company, which could be very risky if Amazon has a hard time. If it drops 20%, all of a sudden you're going to see that in your investment portfolio. And that could be a big difference. So there's ways that you can avoid that risk. And that's where mutual funds and exchange traded funds or ETFs come in. And so there will be mutual funds or index funds, mutual funds and ETFs are baskets, effectively a basket of securities, a basket of stocks or bonds. It allows you to be able to buy in to different companies without having to buy each company individually. So for example, if you wanted to buy Amazon, but you don't want to just put so much money into that one stock, you can go take your $1,000, you can buy a mutual fund that tracks the overall stock market. That's what we call an index fund because it's tracking the general stock market index. Now your $1,000 is spread across about 3,000 stocks. Much less risk that way. If Amazon goes down 20%, you'll probably still see that, you'll notice that, but it won't be as big of an impact as if your whole $1,000 was in that one stock. So for investors that are just starting out, just getting going, mutual funds, ETFs are a very good way to reduce your risk while getting general exposure to those stock markets. So now let's talk about bonds. Mark teased us on that one. So let's talk about what a bond is. Different from stocks, bonds, you're actually lending money to a company. So that's you being the lender. The company is now the debtor. They're borrowing money from you. So in return for the money that you're going to lend them, they're promising to give you back that money plus a certain amount of interest depending on what the market conditions are at that time. As Mark said, the safest kinds of bonds are government bonds, those treasury bonds, because as we know, it's very, very unlikely that the U.S. government is going anywhere or is not going to be able to pay their bills over the long term. Now, if you want to go buy a bond from somewhere else, say a few years ago you went out and bought a Sears bond, you might have not been very happy a year or two later when Sears went bankrupt, because that bond, although you lent them the money like anything else, they have to be around in order to pay you back when the time comes for that bond to come due. So it's kind of like if you have a buddy or a friend who you're going to lend money to, you better make sure he can pay you back. It's the same thing with bonds. Make sure the company you're investing in, you're buying the bond from, is going to be able to pay you back at the end of that term. So just be careful how long, and it depends on how long you hold them and then the type of company it is. So then the safest, really, if we look at the safest type of investment, it's cash. Cash is, as the saying goes, cash is king a lot of times. Cash is safest. Usually you're holding that in a bank account, a savings account somewhere. Now, because it's the safest investment, it doesn't always pay the most interest compared with a stock or a bond. It's not going to go up quite as much because it's cash. But you can hold that again, regular savings account, regular checking account, or you can buy what they call a certificate of deposit, or a CD. Now, CD is very similar to a bond, except instead of you lending money to Apple or ExxonMobil by buying a bond from them, you're lending money to a bank, say Bank of America or Corning Credit Union, Wells Fargo, whoever it is. So you buy a CD from them. They are now going to be the person borrowing money from you. They're going to set the terms, how long that's going to go out, year, 2 years, 3 years. And then they're going to set how much interest they pay, and then you decide if you want to buy that CD or not. Okay, so at the end of that time period, they're going to give you your money back plus whatever interest they promised to pay you. And the good news about CDs versus bonds or cash in general is that there's some insurance built into this. This is kind of what Mark talked a little bit about. This is the Federal Deposit Insurance Corporation, or the FDIC. You may have heard those letters before when you're talking about a bank account or about cash. The FDIC insures or promises that you will be protected up to $250,000 in a bank account or in cash. That's a CD, wherever it is. So let's say you go down the street to Joe's Bank and you decide you're going to open an account and you're going to put $25,000 into that account. Turns out Joe's not a very good banker. His bank closes down. That $25,000 is protected. As long as it's under the $250,000 limit, the FDIC says, well, they're going to step in, they're going to make you whole, they're going to give you your money back. So that's the good news about cash. Very safe as long as you stay under the FDIC limit and you're with an organization that has that limit in place. Okay. So now we're going to shift gears and look at some alternative investment products. These are ones you won't necessarily find traded on the stock market. First up, we'll talk about life insurance. Now, life insurance is where you're going to pay money to a company, and the company is going to promise to give your beneficiaries money, a certain amount of money at the end of after you die, at the end of your life. Now, there's a couple, as long as the policy is active. That's a big key. You have to make sure that life insurance policy is still active when you die, otherwise they obviously are not going to pay that benefit. Now, there's two types of life insurance policies generally. There are permanent life insurance policies, and then there are term policies. So permanent policies are these whole life, universal life, variable universal. Those are all permanent. That means that no matter how old you are, if you still have that policy and it's still active and you paid your premiums, your beneficiaries are going to get that money. They're going to get that death benefit after you pass away. A term policy is a little different. Term policy is only for a set amount of time. That's the name term. 20 years, 30 years, 10 years, whatever it is. So you look at this and you think, why in the world would I buy a policy that only lasts for 10 years or 20 years when I plan on living a lot longer than that? Well, there's a big reason, because term policies tend to be a lot cheaper. They're a lot less money. And what we're looking at here is life insurance doesn't necessarily have to be an investment. If you have extra money, you can be investing in other areas. You don't necessarily need to use life insurance as an investment. A lot of times what we're looking at it as is as a vehicle to insure against risk, to protect you from risk. Risks such as your mortgage, your kids' college expenses, and those kinds of things that you have as you're going through your life. So a term policy allows you to cover those risks at a much lower cost than you would if you got a whole life policy or one of these other permanent life insurance policies. And then you can take that extra money necessarily that you haven't paid, go invest that somewhere else. And there's a very good chance, hopefully, you cross your fingers, you live longer than your term policy is in effect. You won't get anything out of it then. You basically spend all that money and you don't get a return. But the good news is you've spent less money and you've covered your risk. If something had happened to you during that term, you'll get the same death benefit as someone who got one of these other policies, but you spent a lot less money doing it. So that's just something to watch out for with insurance. Make sure that you're covering risks, not necessarily using it as an investment vehicle. Although again, it can be, like for example, variable universal life. One other thing is you pay your premiums, a piece of that premium is going to go into a cash balance for those permanent policies. So if you wanted to cancel your policy in 10 years, you get your cash back. So it's what you put into it minus the cost of the insurance, which can be pretty high. So in the variable universal life, that cash balance can be invested in mutual funds or whatever, and that can actually drive up the value of your policy over time. Again, you can do that in the regular stock market using mutual funds or something else without having to pay the cost of the insurance. All right, so the next investment type is real estate. And now this one could be certainly your own home, your personal residence where you live. It could also be a rental property if you decided you want to own a property and have somebody else live in it and pay you to live in that property. This is something that's really dependent on the location, which we'll talk about in a minute. If you buy something in an area, a house or real estate in an area where the market's doing well, then there's a pretty decent chance that you can hold it for a few years, turn around and sell it, and you get to pocket the difference on whatever that house has grown to in value. So that could be good. If you're in an area where the housing market is flat or maybe it's gone down a little bit, then real estate investing could be something that costs you some money. In addition, there's some other downsides to real estate you have to watch out for. If you're investing in a rental property, if you don't live in the location where your rental property is, it's very difficult to be what they would call an absentee landlord. You have to probably hire a management company to watch over the property for you. That could be very costly. If you do live in the same town where your rental property is, you may have a tenant who calls you all the time. And maybe you're over there at 2 or 3 in the morning fixing something. You may have a problem with a tenant who causes damage to your house and you have to fix it. There's a lot of things that can happen which can cost you money in rental properties. So upside is good because if the housing market does well, you can turn around later and sell the property and get that gain. But you just have to make sure you go into it with your eyes open. And again, back to the location, as we talked about, that's very important. Certainly, especially when we're talking about the risk in these real estate investments. If you're buying a property on Cuca Lake, has a much different risk structure than if you're buying a property, a duplex in downtown Corning. Much different levels. So just make sure as you're doing that, if you want to invest in real estate, make sure you pay attention to the area, make sure you pay attention to some of the other variables and be careful. So next up we have commodities. That's another alternative investment type. And this is physical, tangible items, things that you can taste, touch, smell, and so forth. Some things such as, you see there's gold, silver, lumber, oil, those kinds of things. Now, most investors out there, you're not going to go out and buy 2 or 3 barrels of oil, put them in your backyard, hold them for a few months, and then turn around and sell them to somebody else. That's not how this works. And that's why commodities are a little more difficult to trade, because you're not usually trading in the physical items outside of buying gold coins or something, right? That's certainly something you can buy. But for the most part, what you're doing is you're going to buy probably an option, which allows you to buy or sell that commodity at a certain price. And then you're going to turn around and sell that option later on when hopefully it goes up or it goes down. You're not actually going to sell the commodities, those options that end up getting traded. So commodity trading can be a little tricky. That's one that you probably want to look at a nice mutual fund where you can get some exposure to the area without having to actually go out and trade physical lumber or oil or anything. Now, gold is different. Gold, silver, precious metals. There's certainly plenty of people who see gold specifically as a very safe investment vehicle, as a way to hedge against some of these other things we've talked about. You know, they look at the stock market going down, let's go buy gold because it's safe. You figure you've got a tangible item, you can hold that gold coin in your hand, and you can turn around and somebody's always going to want to buy your gold. So that's true. Like anything else, though, you want to spread out your risk. Don't put everything into gold, don't put everything into the stock market. Okay, next we have employee benefits. Now, employee benefits, they're not really an alternative investment type, but they're in here for a specific reason, because it will make up a part of your investment portfolio. Specifically, as an employee, you have 401ks, 403bs. These are retirement accounts. As an employee, you get access to a retirement account, and you can then contribute to that out of your income over time. A lot of times, your employer will contribute to that as well, and that allows you to grow that. And that becomes part of your overall investment, your overall net worth. Beyond that, your company may offer something called a stock option. If they do, a stock option is effectively an agreement which allows you to buy shares of the company that you work for at a certain set price. And though that agreement usually lasts for about 10 years. Now let's go back to our Amazon example. Let's say you work at Amazon now. Amazon feels you're doing a good job. They give you an option to buy shares of stock. Let's say it's 100 shares at the current price, which is around $100. So you hold those options 3 or 4 or 5 years later. Now Amazon stock is trading at $300 a share. Well, you can take those options you have, you can exercise those, and now you can go buy those 100 shares of stock for $10,000, even though somebody else would have to buy it for $30,000. You can turn around and sell those, and now you've made the difference on that investment. So stock options can be a very nice benefit as an employee, especially if you work for a company that's growing or a company that has a stock that's growing. So that's something to watch out for. Beyond that, there's certainly many other types of employee benefits that are not especially in the investment side, but will factor into your overall daily living. Life insurance, health insurance. You could have regular bonuses, vacation and sick time, paid time off, those kinds of things. So all of that factors in. You want to make sure as you're going about your day-to-day life and your job, always be watching for the employee benefits. Companies will change benefits from time to time, so you want to make sure that you're always looking for, have they added something new? Is there something different you want to watch out for? Especially on the health insurance side, health insurance plans are always changing. just be aware of that, especially if you're starting a new job. Always want to look at those benefits that they offer so that you're not missing out on something that they may offer for you. All right, so then the final alternative investment that we'll look at tonight is collectibles. Collectibles are exactly what they sound like. These are things that you're going to invest in or that you're going to collect, which you hope at some point in the future will be worth a lot more than they're worth today. Okay? You see a lot of pictures up here. This will give you a good view of a lot of these different things. Sports memorabilia, cars, coins, stamps. Right? So these are all things that people can collect. And I'm sure we've all tried to collect something of this nature in the past. Right? Now, the key to collectibles is you have to make sure that it's something that you think, well, two keys to it. First of all, you can collect something just because you enjoy it. Right? It doesn't have to have value. It can have value to you. That's always out there. The second thing, though, if you're trying to do it as an investment, you want to make sure it's something that you expect will grow over time in value, or that will have value to somebody else at some point in the future. So you'll see a lot of these days. You see sealed items, right? Sealed video games, or a sealed movie, a VHS tape. Those old VHS tapes from when we were kids. They're sealed, and so people will pay a lot of money sometimes for a sealed copy of this. I'm not sure why, but it's something people do. That's a collectible. That's something that can be valuable to somebody. If you've been collecting dryer lint in the ball at home, that may be valuable to you, may not be valuable to anybody else. So you just got to be careful. So just watch out, make sure that it's something that you're collecting either that has special value to you or that you can turn around and have value. So let's pull everything together now and look at this. This is a balance sheet. We're going to talk a little bit about what this means. We've talked about traditional investments. We've talked about alternative investments, soft investments like life insurance, employee benefits, and whatnot. So when we're putting together a balance sheet, when you're putting together a balance sheet for yourself, this is what it's going to look like, and it's going to include everything that we've talked about. All of those things go into that, and that makes up what your net worth is. So if you look at this, and if you look at the pie chart over here, the pie chart's going to take this and make you a good visual representation. So what's great about pie charts is it's a real quick way for your eye to look and check on something to see if there's something that's maybe out of balance. For example, with this family, if you do a quick look at the pie chart, you can see rental properties, vacation home, and resident in their home residence. If you look at the whole pie chart there, that's over 50% of their overall net worth just in real estate. Is that a good idea? It probably depends on this person's situation. We don't know who they are. We don't know where they are in their life. But having more than 50% of your net worth tied up in real estate could be a little risky. If something happened to their tenants in the rental property, something happened to that vacation home, they could find themselves in some trouble. So this is something that's good to do for yourself. Take a look and see, am I overbalanced in a certain area? Am I creating risk for myself? And we'll talk about risk here in a couple minutes. One other thing I wanted to point out on here, you'll notice on the actual balance sheet, term life policy for $1 million. So this is what we talked about before. If you look over in the pie chart, that term life policy isn't shown anywhere here. You'll see the whole life policy right there. That's kind of small. Whole life policy is on there. That's the $30,000. But that $1 million would make a big difference on this pie chart, but it's not on there anywhere. And that's because a term policy has no value unless you're dead, right? While you're holding this during your life, if something happens to this person, certainly that's $1 million that's there to protect their family. If they live past the term, that $1 million goes away. So it has no current value. Therefore, you can put it on the balance sheet because you want to track it, but it's not going to go in here because you don't want to make it look like you have that $1 million as part of your overall portfolio. So just a small little break. So let's talk a little bit about risk. We talked on and off about risk a little bit tonight. I wanted to circle back and kind of show you some discussion questions that you can use for yourself as you're evaluating an investment. It's something that we would use as an advisor if I'm sitting with a client. I'm going to go through these kind of questions. Let's say I'm sitting with a client and they come to me and say, I want to buy a rental property. We're going to kind of go through these questions in some way to decide is that a good idea for them based on their risk tolerance, which we'll talk about in a minute as well. So first of all, does the investment that they want to do, does that match up with their goals and their time horizon? That's the first question. If they're just starting out in their careers, they're just barely getting going, they got a long ways to go till retirement, buying a rental property might not be a good idea. It would use up a lot of their capital. It would put them, they won't have a lot of cushion, maybe, or a lot of what they would call runway to help them if something happened in that rental property. Consequently, if you have somebody who's close to retirement and they came in and sat with me and they said, I want to put 2 years away from retirement, I would put 100% of my retirement account into the stock market. That's probably not a great idea either, because again, timing. You're 2 years away from retirement. If something happens in the stock market, you don't have enough time to make up that loss. So it's risky. Again, risk is what we're looking at. So that's time horizon, and that's comfortable. So then the third thing, how can they stomach, or how can you stomach a short-term loss? That's that. Are you comfortable with short-term losses? Do you have a cushion of cash? We call that a runway. Do you have something in place where if you lost some money on a certain investment, you'd be okay? If that's the case, then maybe you're okay taking that risk. So for example, if you have someone, who's looking at a really small tech stock, or they have a pharmaceutical company that has a new drug in the pipeline, and they really think it's going to do well, they might be willing to take that risk, even though in the near term it might not do very well because they have other assets to back that up. So then finally, we talked a little bit, and that's 3 and 4 together. Then finally, we talked a little bit about the last one, balance sheet, like we talked about in the last sheet. How is the rest of your household going to do if there was a loss? How much impact would this loss have on your day-to-day living if you lost a lot of your investment? So as another example, let's say you had 70% of all of your investments in baseball cards. You might not be sleeping very well at night as you're watching the card market, because if the card market goes down really far, all of a sudden 70% of your money is in trouble. That's one of the reasons why you want to continue to watch risk, and you want to continue to spread your investment out, spread out your risk across different asset classes. Just being careful not to put everything in one spot. So to the second part of this then, in the end, when we look at this, risk is all about choices, and it's all about your approach to life, right? There are plenty of people who would have no problem walking in and putting 100% of their money into 2 or 3 stocks and letting it run. There are also people who would go to a casino and they walk in with a pot of money and they drop it at a roulette table on number 23 and just let it go. There are people that do that. There are also other people who don't trust banks, who look at something and say, I don't want, I'm very cautious, I don't like the way things are going, and they've got a couple boxes of gold coins and some cash stuffed in their mattress. And that's okay. So when we look at this, the key is that we need to understand for ourselves, and we need to help people understand. That's what we do as advisors. We help people understand their own risk tolerance, and to make sure that as they're making decisions, they understand the risk, and they can make decisions based on what their risk tolerance is. So each of you can take a look at this and certainly put yourself somewhere on this line. The casino roulette player, he's over here. That's a high risk aggressive. The mattress cash gold coin box person, they're over here. That's a conservative, very low risk, right? So again, there's no right or wrong. This is not a right or wrong chart. This is about what works for you and what kind of investments will help you to feel comfortable on a day-to-day basis. And this also gets more interesting if you're married, because married couples often will not have the exact same risk tolerance. So you may have one person who's very aggressive and the other person who's more on the conservative side. So you have to make sure that you're balancing that out. As you learn in a marriage, compromise is the key to success, and it's the key to happiness in the home. And that happens on the risk side too. So in summary, we're going to end this section by just looking at a brief look at our service model as a company. So as a comprehensive wealth manager, our goal is to provide holistic service by merging investments, investment management, and financial planning. This starts with getting to know our clients by gathering a lot of information and discussing their goals. After that, we're going to develop a plan that will help them to reach those goals, which then hopefully matches up with their risk tolerance, like we saw on that last screen. Then we're going to assist them in executing that plan, and over time, we'll continue to actively manage it while we also review any life changes. Because as we know, any plan you make in life is going to have to be changed. Nothing is permanent. There's no perfect plan. There's no plan that's set in stone is going to work for the next 20 or 30 or 40 years. So it takes continuous review, takes continuous adjustments over time to make sure that you can get where you want to be. Our job as financial advisors, anyone's job as a financial advisor, should be to help people to do these steps to make sure that they understand their goals, they understand their risk, and to help them get to where they want to be and hopefully get a good night's sleep along the way. So with that, we'll open it up for questions.
Yeah, we actually have a few.
Okay.
I have two, and then Amelia has one for you guys to tag team.
Okay.
The first one is on insurance. If term life insurance doesn't actually affect your true net worth, is it worth it?
Great question. So some of that will depend on what you're trying to do. So term insurance as a general policy will work because while it's not part of your net worth, the goal with insurance should be to manage your risks in life. So if I'm 30 years old, I've got a young family, and I've got a mortgage, if something happened to me last week, my family could be in a lot of trouble. So having that life insurance in place protects my family for the next 20 or 30 years to make sure that if something happens to me, the mortgage is paid off. My kid's college is at least on the way, if not covered, and everything is okay. Now, I could do that with a permanent policy, but the problem with the permanent policy is it's going to be more expensive. It will come into my balance sheet, certainly, but I'm now paying a lot more. Especially with a young couple, they may not have the cash that they need to be able to get that insurance in place. On top of that, if you look ahead, that policy is going to be in place forever. So you may be 90 or 95 years old. That policy may not be worthwhile. You may not need it anymore. Now you paid premiums all of these years for a policy that is still there, but based on your asset level, it's not really needed. Your kids will be fine. Everything's fine. You've got all the money you need. So having that term policy allows you to cover those risks that you have at a lower cost, which is a good entry point. Now, everything's good for it. Some people would look at that and they say, I'm not doing a term policy because it's like renting versus buying, right? I don't want to rent a property. I want to go buy a house because if I'm renting, I'm just throwing money away. Some people look at term the same way. I don't want term policy because I'm just renting that policy. And if I live past it, then I've thrown all that money away over the years. So it really just depends on what people will do. There are certainly good benefits to hold to permanent policies. There are some permanent policies that'll have a piece of it that can be used for long-term care insurance in the future. Those can be very beneficial because you can take that death benefit and pay out your medical costs in the future. So like anything else, there's good and bad, but that's how I usually would approach a term policy first for the client.
Okay, the next question I have is a little bit more on the employer benefit side of things.
Okay.
If the company you work for pay you with equity and you have options that you need to exercise, is there a risk of not doing anything?
That's another good question. So the risk of not doing anything is you've just missed out on a benefit. So there's no risk in the sense that you've lost money because you didn't put your own money into it until you actually exercise the option. So a company gives you 1,000 options to buy their stock. They're giving you that money. It's not taxable to you at the time you get it. You haven't paid any money for it. So let's say the 1,000 shares, the company was worth $20 at the time. Well, if the stock goes down to $10 and it stays at $10 for the next 10 years and the options expire, you wouldn't want to spend the options anyway because your option says you can buy it for 20 and the stock is worth 10. So you would just go buy the stock. You're not going to spend 20 to buy a stock that's worth 10. It would be worthless, right? So some of that depends on what the stock does. But what you're walking away, what you're missing out on is if the stock went up and you didn't exercise those options and then they expire, you just missed out on that benefit. It's somewhat free money. You pay tax on the difference a little bit, so it's not entirely free, but they're giving you this money, and if you don't use it, you've just missed out on that opportunity.
Okay,
Yeah,
so
I'll just add on that. Darren mentioned before the importance of diversification, right? You don't want all your money in a baseball card. You also don't want all your money in a stock option, right? So it's oftentimes better to diversify away that risk, exercise the option, and look for a wide range of investments to invest in.
And that's a great point, especially when you're talking about your own company, because you have, especially when you're young or mid-career, you've got your entire salary coming from that company. You probably got stock options. You may have company stock in your 401k. That's a lot of risk, a lot of eggs in that one company basket. If something happens to that company, you may be in trouble. So Mark's got a great point. Spreading that out by selling some of those options off or doing that over time, you don't want to just save them trying to get everything at the 10-year mark.
To expand on that, were you here back in the tech bubble when Corning stock went down, how that affected everybody locally? I don't know if you want to share like the risk.
I wasn't here yet. I heard the stories though. Yeah.
Okay. You want to share any of the stories that you heard? So that's a perfect example.
Well, yeah. So
of that.
Corning Inc. John Ullman likes to tell that. He was certainly here for all of that. Corning stock was at a high over $100, $100 and something, ended up at $1.12, I think. Somewhere at $1, it lost 99% of its value effectively. So anybody who was holding Corning stock in their 401k at a Corning employee, if they were holding it, it went all the way down, bounced back. But that's certainly a good example of how you have to be careful not to put everything into that one basket.
And then even during that time, there was talks of moving headquarters, which would have affected your real estate pricing. So going back to the visual of the balance sheet, all of your eggs in one basket, that's all tied into your employer. And that's why, to Mark's point, diversifying is so important.
Absolutely true.
I got another question. I'll let Amelia take.
Yep.
Okay. So this question that came in mentioned that, that the presenter said that the US government will be able to pay its bills. What about the current stories that say that the government is reaching a debt ceiling and may not be able to pay its bills after June 1st?
Yeah, so I can start with that question.
Oh, yeah.
And, this is a story we follow every day. And there is this deadline essentially on the government to raise this debt ceiling, which is passed by Congress. So there's a debt ceiling limit. And the government has approached that limit. So we have mentioned this $31 trillion in debt. That's actually, government debt went up a lot during the pandemic, right? You had this crisis, the government had to spend money and intervene, debt went up. But now there's a debate, essentially between Democrats and Republicans. Republicans are saying we need to reduce spending and just keep raising the debt ceiling. And the Democrats are saying we need to increase this debt limit. It's coming up week. So we need to increase this right away to pay our bills and pay our debts, right? So our take is that it would be unimaginable for a prolonged default. And there are other, I read today in the Wall Street Journal that President Biden is looking to Amendment 14. And there are some ways they could kind of manage this in the short term, but it would be unimaginable for the government to default on its bills, not pay government employees for a prolonged period of time. There is a scenario where politicians make a point and there is a short-term default. Right? So that is a risk for owning government bonds, is that that thing does not get raised and there is a default short-term by the government until a deal gets hashed out. So essentially the government has to increase this debt limit to issue more debt, pay its bills, and pay off past debts, which we think will happen. But the market hasn't priced in this scenario of a default. So there's risk to the stock market and the bond market as well.
They got close to 2011, right?
Yeah, and President Obama basically went through the same thing. And there's a short-term situation there where government employees were waiting for their paycheck. Right? So
it was a couple of days. It wasn't very long before they fixed it.
Right. So that may happen again. It would be a disaster to the economy if the government went months and months, and maybe say a year. That'd be a disaster for the economy if the government wasn't paying its bills for that long. So there is a scenario where you have a short-term period of government default due to the legislation that caps the amount of the government can take in debt. A great question.
They'll fix it.
Yep.
May I ask a personal hypothetical question? I'm 93 years old. I have a house on the lake, which I will be selling within the next couple of months. Say I end up with $500,000. Our mortgage is paid. I have that to invest. What would you suggest I do?
So obviously you'd want to look at your personal situation to see, but you could take some of that. You want to be very careful with it because you want to make sure you have enough to take care of yourself for the rest of your life. So probably keeping some of it safe. You want to balance whatever you do. You want to balance it. You don't want to put everything, like Mark said, into one thing or another. But you're investing, looking ahead to the future as well for others, figuring that anything that you don't spend can go to other people, right? So you want to have a little bit of growth. You want to have something in the stock market so it can grow, but have something that's safe and protected as well, out in bonds or cash or CDs or something where it can kind of keep you from kind of protect that principal as well. So balancing would be the key to that.
Is an annuity a good idea?
Annuities depends on the situation. So annuities can be a little tricky because there's a lot of fees to them. In some situations, they can work very well. The thing with annuities is you're making a bet that you're going to outlive the annuity value, right? So if you're looking at saying I'm going to live another 15 years, they're probably pricing it for you to live 8 or 10. You make out because you get an annuity payment for the rest of your life, right? So annuities can be, the nice thing about an annuity is it's a stream of definite payments. They're going to pay you this amount of money for the rest of your life. The downside is, depending on how the annuity is structured, it can be over pretty quickly, depending on how you want to do it. So I would think you want to look at it and see how expensive it's going to be versus what the payments are going to be. But you may be able to do the same thing, just putting the money, investing it somewhere and just making regular distributions to yourself out of that mutual fund or whatever you're investing in.
A couple local banks where I have funds now, they're approaching me saying they have financial advisors on their staff. Now, as I understand, that money is not insured. It's not covered by the FDIC.
If they're investing in it, they have a different type of insurance for investments, but it's a different amount. They call it civic, but yes, so it's different than the FDIC.
Now, is that a safe alternative to go to someone like that? And I assume that they're out to get the best deal for themselves.
Well, hopefully if they're so what they call fiduciaries, then they should be acting in your best interest first.
Where do you find a fiduciary?
So anybody that is at a bank should be a fiduciary. Anybody who's a certified financial planner is a fiduciary, like we are. You see others like that. So anybody where you can find, say, look for the CFP designation, because that means that they're required to be a fiduciary. So fiduciary means they're putting your interests first before anybody else's.
It's like the ad on television.
Yes, that's right. Yeah. So depending on what you're investing in, anything could be safe or anything could be risky, right? So as long as they're being careful, whoever it is that you're working with, as long as you're being careful, you can do something that would not put you in a bad spot. Good question.
Yeah, very good question. If I may add, to your first question, I think it's important you put a balance sheet together. Darren showed that example, listing all your assets. That's your personal balance sheet. It should give you a kind of clearer picture of how much risk you want to take. Also, the risk is to find out how much spending you want to do over the next coming years. And my only suggestion is I'd be careful with that annuity, because oftentimes annuities, they have high fees in them. And it's really better if you manage the money through investments, other ways, in this day and age. Back in the day, where the information flow wasn't as good, buy an annuity, have peace of mind, and get paid this monthly income for the rest of your life. But it depends on your personal circumstances. Darren did mention life expectancy is achieved.
At 93, I wouldn't buy an annuity if it were me. I would do that.
Currently, I have an annuity through Kruger College.
Mm-hmm.
I donated $51,000 worth of stock, and I assume that I have outlived their estimate already.
It's a charitable annuity, right?
A charitable.
Yeah, those are fantastic. We have those for a lot of our clients too. Those are good. Yeah. So you give them the money, and then they pay you a certain amount every year off of the money that you gave them. And then many, many years from now, when you pass away, they take the balance of it goes to them, and they put it into their.
Because I think I've almost gotten back the 51,000.
I bet you have. Yeah, because they usually they'll invest that, and then you get those investments, the income that comes out of that. Those are a good deal because you're doing the charitable piece. You get the tax benefit when you do it, and you're helping them in the future, but you still get access to the income. So it's good.
So that's a wise decision to make on my own.
It was, yeah, the one that you did, certainly.
I mean,
yeah.
What was the money from the house now?
It could be. I'd say you'd want to probably sit down, to Mark's point, and look at all of the different options and kind of weigh everything. And certainly talking to somebody to talk through all that would be that'd be a good idea to kind of work through, bounce ideas off them and see what works out. So another charitable annuity could, if you have charitable intent where you want to give some money away, that would certainly be a good alternative.
We have one more question, and then we're gonna come to a close shortly. It's a very simple question. All it says is gold versus treasuries. What should we do? That's it.
That's a great question. It depends on your time horizon there, but they're both seen as safe haven assets. So if people buy gold during a financial crisis, during uncertain times, and they also buy treasury bills and sort of save. Right now, you have that debt ceiling issue, right? So maybe you lean more towards gold than you're looking for a safe haven asset. And essentially by safe haven, you're thinking about assets that you buy that you feel comfortable won't go down a lot in a crisis. Right? So gold tends to have some staying power in a crisis. Same thing with treasury bills. Longer term, I think you want a more balanced portfolio with further options.